Welcome to Talk Tickers. We dive deep into earnings calls so you don't have to, bringing you the essential insights.
Yep, and today we're looking at super microcomputer, ticker SMCI, big name in IT and AI infrastructure.
Absolutely. Our mission today, break down their latest earnings call, figure out what worked, what didn't, and where they're heading.
Okay, so let's start with the headline numbers for their third quarter, fiscal 25. Net revenue came in at $4.6 billion.
Which was actually a bit lower than forecasts, right?
It was, yeah. Now it's still up 19% compared to the same time last year, which isn't bad.
But it was down compared to the last quarter.
Right, down 19% quarter over quarter. So a bit of a mixed bag on the top line.
And earnings. How did profitability look?
Non-GAAP EPS, earnings per share, was $1.31. That's down from 66 against the year ago.
Okay. Down quite a bit then.
Yeah, there are reasons for that we'll get into. But looking ahead, they sound pretty confident. They're projecting Q4 revenue of at least $6 billion.
A big jump from Q3.
A very big jump. And one other thing, they managed to get back into compliance with financial regulations, which is, good housekeeping.
Definitely good news. Okay, so a softer Q3, it looks like, but a bullish forecast for Q4. Let's dig into that Q3 revenue dip first. Why the sequential decrease?
Well, the main story seems to be customers hitting pause. They're anticipating these new AI platforms, specifically the ones using Nvidia's Blackwell GPUs.
The next big thing everyone's weighing.
Sort of, yeah. Many customers decided to delay their orders, likely to evaluate Blackwell, see how it performs, maybe shift their plans. Supermicro thinks those orders will mostly land in the June and September quarters.
So deferred, not lost, is the idea.
That's the message, yes. And despite that pause, AI GPU platforms still made up over 70% of their Q3 revenue. So demand is still fundamentally strong.
70% is still huge. Where's that demand coming from? Enterprise? Cloud?
Both, really.
Yeah.
But interestingly, their enterprise channel revenue was actually a bright spot in Q3. It hit $1.9 billion.
Which is what, percentage-wise?
42% of the total revenue. And that was up 3% year over year, but get this, up 38% from the previous quarter, Q2.
Wow, 38% sequentially. So enterprise customers were buying strongly.
It looks like it. Suggests they're adopting maybe the current gen AI and CPU platforms pretty readily in that segment.
Okay, what about the other side, the big data center and OEM customers?
Right, so that segment brought in $2.6 billion, which is 57% of the total revenue.
Still the majority then.
Still the majority. And it was up 35% compared to last year, so strong annual growth. But it was down 38% compared to Q2.
Mirror image of the enterprise growth, almost, down 38%. Any specific reason?
Well, part of it is likely that Blackwell pause hitting harder there. Also, they mentioned two very large cloud customers made up 22% and 14% of revenue, respectively.
So quite concentrated. If one of those big guys pauses, it really shows.
Exactly. It highlights that concentration risk. Geographically, the U.S. is still dominant, about 60% of revenue.
And elsewhere?
Asia was 30%. Europe, 6%, rest of the world, 4%. But Asia and the rest of the world showed really significant growth year over year.
Expanding globally then? What about China?
Less than 1% of sales.
Yeah.
So not a major factor there.
Okay, got it. Let's shift to profitability. You mentioned the EPS was down. What happened with margins?
Yeah, the non-GAAP gross margin was 9.7% in Q3. That's down about 220 basis points from 11.9% in Q2.
Why the drop?
Couple main reasons. One was higher inventory reserves. They basically had to write down the value of some older generation GPUs and parts.
Making way for Blackwell, presumably?
Precisely. Clearing the decks. Also, just lower sales volume overall hurts margins, and they had some accelerated costs tied to launching new products.
Investment spending.
Okay.
And operating expenses.
Non-GAAP operating expenses were actually down 5% from Q2, which helped a bit, but they were still up 30% compared to last year. Came in at $216 million.
So the net effect on operating margin?
It dropped. Non-GAAP operating margin was 5%, down from 7.9% in Q2. Just the combined hit from lower revenue and those lower gross margins.
Right, a transitional quarter, it sounds like. Cleaning up inventory, investing ahead of the news cycle. What about that guidance again? Q4 looking strong.
Yeah, Q4 net sales expected between $5.6 billion and $6.4 billion.
Yeah. That's
a big range, but the midpoint is, way up from Q3.
And the earnings guidance for Q4?
Non-GAAP EPS projected between $0.40 and 50 cents. Still quite low compared to historical peaks, but an improvement.
And margins for Q4?
They're guiding gross margins to around 10%. They mentioned being prudent, partly because of tariffs.
The tariff wildcard. Okay. And the full year?
For the full fiscal year 2025, they now expect revenue between $21.8 billion and $22.6 billion.
Still a huge year, even with the Q3 dip.
Absolutely. And while they didn't give specific numbers for fiscal 26 yet, they sounded very confident about the midterm and long term. Blackwell is obviously key, but they also kept mentioning this DCBS.
Right, DCBS, Data Center Building Block Solution. What exactly is that? Sounds important.
It does. It seems like a pretty major strategic push. It features their second generation direct liquid cooling DLC2.
Liquid cooling. Getting essential for these powerful AI chips, right?
More and more so, yeah. The idea behind DCBS is to offer a more integrated, kind of pre-engineered solution for building data centers, especially for AI.
Like Lego for data centers?
Kind of, yeah, building blocks. They claim it can streamline construction, cut the total cost of ownership, or TCO, by up to 30%.
30% is a lot.
It really is. Plus, optimize space, water usage, and speed up deployment time getting the data center online faster.
That time to market is crucial for AI rollouts.
Exactly. They mentioned shipping 4,100 kilowatts of AI racks with their first-gen DLC last year, and they want to double that. And this new DLC2, they claim, could save up to 40% in power and water. And be quieter, too.
So it's a shift from just selling components to selling a more complete, optimized system.
That's how it sounds. A move towards integrated solutions.
Yeah.
It could really differentiate them if it works well.
And are they building the capacity to deliver this? You mentioned global expansion.
They are. Their new plant in Malaysia has started shipping. They're scaling up facilities in Taiwan and Europe, and also increasing manufacturing here in the U.S.
Spreading the footprint. Makes sense with supply chains and tariffs being what they are.
Yeah, it gives them flexibility, potentially lower costs, and aligns with, government pushes for domestic tech production.
Okay, let's talk about managing the money side. Inventory and cash flow. How did that look in Q3?
Inventory ended Q3 at $3.9 billion. That's up about 7.6% from Q2.
Building up stock for that big Q4 they're expecting.
That's the plan, yeah. Preparing for higher shipments. And cash flow looked much better. They generated $627 million from operations in Q3.
That's a big swing from the previous quarter. Wasn't it negative then?
It was, yeah. It's a significant improvement. They also did some financial maneuvering, amended some older convertible notes, and raised $700 million in new ones.
Why do that?
To boost working capital, basically. Fund R&D, pay for that global expansion we talked about. Standard practice to ensure they have the cash needed for growth.
And the result, their overall cash position.
They ended the quarter with a net cash position of $44 million. So more cash than debt. That's up from being in a negative net cash position before. Generally a positive sign of financial health.
Definitely sounds healthier. Okay, switching gears to demand and competition. What did they say about orders and the market environment?
They said order trends right now for the June quarter look strong. And they expect September, when Blackwell really starts shipping in volume, to be even stronger.
So the pause is ending, seems like.
That's the indication. Now, they did note that while demand for specific liquid-cooled products like their GB200 racks is high, the broader adoption of fully liquid-cooled data centers by customers has been a bit slower than they might have hoped.
Maybe it takes time for customers to adapt their facilities.
Could be. Infrastructure changes, maybe some learning curve. But Supermicro is really hammering their first-to-market advantage with the new stuff, B200 HGX, GB200.
They're also offering AMD chips, right? Not just Nvidia.
Yeah, they mentioned offering AMD's MI325X solutions too, so covering their bases.
Yeah.
But they clearly believe their own mature liquid cooling tech, DLC and now DLC2, is a major competitive edge, especially for the really hot chips coming down the line like B300.
Is getting enough of these new Blackwell chips a problem? We heard about shortages with Hopper.
They mentioned some initial allocation constraints, which is normal for a new launch, but said the situation seems better than it was during the Hopper ramp-up. So supply might be less of a bottleneck this time around.
Hopefully. Okay, better supply, strong expected demand, betting big on liquid cooling. Makes sense. All right, let's pivot to our This Is Not Financial Advice segment. Time for some outrageous but plausible trade ideas based on all this. What's your first one?
Okay, idea number one. Given that huge expected ramp in demand for Blackwell, especially hitting the September quarter, and management's confidence they can kind of repeat the Hopper history with massive sequential growth. How about this? A long call option. Strike price significantly higher than where the stock is now, maybe expiring late Q3, early Q4 this year, 2025.
So a bet on a big stock price jump when those Blackwell numbers really start hitting the income statement.
Exactly. You're playing for that expected revenue surge and the market getting excited about it again. But, and this is crucial, it's highly speculative, very dependent on them executing perfectly and, the overall market staying rational.
High risk, high potential reward. Definitely outrageous, but plausible. Okay, got another one for us.
Idea number 2 focuses on that DCBS strategy. Supermicro is pushing it hard, talking up the cost savings, the efficiency for AI data centers.
The integrated solution play.
Right. So consider a pairs trade. You go long Supermicro stock.
Believing their integrated solution strategy will win.
And simultaneously, you short an ETF that focuses on traditional data center REITs, the companies that just own and lease out the physical buildings.
Betting that Supermicro's approach might make the traditional model less attractive or valuable.
That's the thesis, yeah. If Supermicro's integrated liquid-cooled building blocks gain traction, maybe it impacts demand for the less specialized traditional data center space. It acknowledges Supermicro's disruptive potential.
But that's complex. You've got market risk on both sides of the trade.
Absolutely. Pairs trades are tricky. The whole market could move, or the REITs could do well for other reasons. Again, outrageous, but plausible, not a recommendation.
Definitely food for thought there. Okay, let's wrap this up. What's the main takeaway from Supermicro's quarter and outlook?
Well, I think Q3 clearly showed a company in transition, navigating that big shift to the next generation of AI tech. The numbers dipped short term because of that Blackwell anticipation.
But the outlook seems strong.
Very strong. They're expressing a lot of confidence in a near-term recovery, starting now in Q4, and then really accelerating with Blackwell, plus this longer-term bet on their data center building block solutions. The next few quarters are really going to show if that confidence is justified.
Yeah. Execution will be key. Watching that Q4 report and hearing about the Blackwell ramp and the early DCBS adoption will be critical.
For sure.
And of course, the usual reminder for everyone listening, this deep dive, it's purely for informational purposes, definitely not financial advice.
Please do your own research. Dig into the full earnings release, the presentations, before making any investment decisions.
Absolutely. Thanks for joining us for this deep dive into Supermicro. We'll catch you next time on Talk Tickers.